Ask the public markets to value Western Union, and the assessment is usually grim. The consensus paints a picture of an antiquated toll booth operator, weighed down by legacy infrastructure and losing ground to modern fintechs. Look at a recent stock chart, and you see that exact assumption priced into the company's valuation. Investors have modeled a slow, uninterrupted decline. But in May of 2026, Western Union quietly bypassed its own legacy systems. The company deployed a proprietary US dollar stablecoin called USDPT, which was built natively on the Solana blockchain. USDPT is a federally regulated product already settling real-world transactions. This creates a massive divergence between market perception and Western Union's current operational reality. The product is live. Issued by Anchorage Digital Bank, the stablecoin is already integrated with the global exchange Bybit, processing active remittances throughout Latin America. To understand why this deployment forces a recalculation of Western Union's value, we have to deconstruct the unit economics of how they move money, comparing their traditional architecture against this new digital stack. The transition directly targets three structural inefficiencies that have eroded the company's profit margins for decades: dead capital, currency devaluation, and the friction of international settlement. By rewiring the mechanics of its own balance sheet, Western Union is engineering a highly asymmetric risk-to-reward scenario for any investor looking out over the next 3 to 5 years. The mechanical problem of the legacy remittance business is one of immediate availability. If a customer drops off $200 in Chicago, Western Union needs to make that exact value available for pickup in Manila immediately. To achieve instant payout, Western Union relies on correspondent banking, pre-funding nostro accounts in dozens of countries. This leaves billions sitting IRWA's dead, zero-interest capital. Storing local fiat also forces them to absorb massive foreign exchange risk if currencies devalue. When those local accounts inevitably run dry, the system hits its third point of friction, the SWIFT network. SWIFT is a secure messaging protocol that tells banks to adjust their ledgers. It does not move capital. Because it relies on traditional banking hours, a nostro account that runs dry on a Friday night cannot be rebalanced until Monday morning. For decades, Western Union accepted these compressed margins as the cost of doing business. The legacy architecture tied up billions in zero-yield capital, exposed them to volatile currency crashes, and bound their operational speed to weakened banking delays. The new USDPT stack replaces that entire corresponding banking chain. Anchorage Digital holds the cash reserves, the Solana blockchain handles the settlement, and Bybit provides the local exchange liquidity. Dozens of fragmented foreign accounts merge into a single US dollar reserve vault. When initiated, USDPT moves across the Solana network to a partner exchange in 400 milliseconds, instantly dispensing local currency from the exchange's liquidity pools. This sequence completely transfers the foreign exchange risk away from Western Union. The company now holds only US dollars in its reserve, regardless of where the remittances are sent. The risk of currency depreciation is absorbed by the exchange's open market order books at the exact microsecond the trade executes. If the exchange needs to rebalance its US dollar position with Anchorage Digital later, it happens asynchronously in large wholesale batches. The customer never waits for a 3-day SWIFT delay. By collapsing the nostro system into a single stablecoin reserve, Western Union permanently excises dead capital and unhedged currency risk from its balance sheet. Circle's USDC already dominates the general-purpose stablecoin market. The question is why Western Union spent the capital to build their own token instead of using an existing liquid alternative. If routed through USDC, Western Union functions as a distribution channel, paying fees while Circle keeps the interest. By issuing USDPT, Western Union controls the asset, routing the generated yield directly back onto their own balance sheet. Under the Genius Act regulatory framework, centralized stablecoin reserves are not held as idle cash. The capital is invested in short-term U.S. treasuries. The math here is straightforward. Earning around a 5% yield on billions of dollars that previously sat dead in foreign accounts creates a massive, easily quantifiable revenue driver. USDPT transitions Western Union into a sovereign digital asset issuer, capturing compounding treasury yield through its own reserves rather than paying for access to another company's rails. This introduces new structural risks requiring strict evaluation. Western Union must share captured yield to subsidize exchange liquidity. Furthermore, this creates strict counterparty dependency. If a partner exchange collapses, the entire liquidity pipeline breaks instantly. There is also network risk. Public blockchains experience outages. If Solana goes down during peak global remittance hours, Western Union loses its ability to settle transactions until the network validators recover. Finally, there is the competitive threat from the traditional banking sector itself, SWIFT 2.0. Backed by major global institutions, SWIFT 2.0 is a private, permissioned blockchain designed to move tokenized bank deposits instantly, 24 hours a day. Operating strictly between Tier 1 commercial banks, a modernized SWIFT network offers absolute institutional safety without relying on unregulated exchange middlemen. SWIFT 2.0 is designed to connect banks and protect existing margins. The stablecoin architecture bypasses commercial banks entirely, allowing Western Union to reach unbanked populations directly at a fraction of a cent per transaction. The public blockchain off-ramp model carries a heavier structural risk profile. However, its ability to eliminate costs provides Western Union with an economic advantage that legacy banking consortiums are unlikely to match. We are watching a 175-year-old incumbent rewiring its core economics while remaining profitable and cash flow positive. Western Union possesses a physical network of over 550,000 payout locations, protected by an immense, deeply entrenched regulatory framework. A crypto-native startup can copy the Solana blockchain integration in a weekend. They cannot replicate the decades of legal compliance and physical infrastructure required to operate legally across more than 200 countries. Investors must weigh execution and network risks against a simple arithmetic certainty. Consolidating global float into a centralized U.S. Treasury reserve generates guaranteed compounding yield. Currently, the market is pricing Western Union strictly as a legacy business in terminal decline, assigning virtually no value to an operational digital payments infrastructure. If this USDPT architecture continues to scale, eliminating FX risk and capturing yield, the market's current valuation represents a significant mispricing and a deeply asymmetric opportunity for those paying attention.